SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-Baffi Bocconi high-level panel on Do we still need banks? Banks have played a central role in Western economies since the start of the Industrial Revolution. The unique characteristic is to use low-cost funding obtained through deposits to lend to the real economy. Lately, banks' core position in the financial system is facing a multitude of challenges, which today's event will discuss in detail. But before we enter into these arguments, let me ask the central question: why would we care if banks lose market shares and are increasingly replaced by non-bank financial intermediaries? A number of stakeholders come to mind who are materially affected. First, customers. Competition from non-bank financial institutions should increase choice and make financial services cheaper and better. But it also makes consumer decisions more complex, opening the door for errors, disappointments, even fraud, and potentially excluding the elderly and those less fluent with financial matters and IT applications. Second, regulators and supervisors. How to ensure a stable financial system geared towards citizens and the economy's benefit in such a rapidly changing environment? How to include new actors adequately in regulatory regimes to ensure a level playing field? Third, shareholders of banks. How will these structural shifts affect returns? Which banks will thrive? Which ones might vanish? Which NBFI rising stars are worth investing in? Which ones might fail or turn out to be an outright fraud? Think of examples like Wirecard. And fourth, bank managers and employees. How to develop their profiles and skills to ensure the necessary flexibility and new skills needed in a rapidly shifting financial sector. I'm sure that at least some of these questions will be touched upon in the next 90 minutes in one or the other way. Before we jump right into the matter, let me express a big thank you to SUERF fellow Dr. Martin Scheicher, who had the idea for, designed, and prepared this event so thoughtfully and meticulously. Thanks a lot, Martin. Martin is advisor at DG Horizontal Line Supervision of the European Central Bank and a leading expert on financial market functioning and regulation. Martin will open our event with an overview of the burning issues at the core of our theme today. Then, Marja Nykänen, Deputy Governor of the Bank of Finland, will take over to introduce and moderate our panel of top experts in the field. Marja has been a member of the board of the Bank of Finland since 1st of February 2017. Marja is, among other things, responsible for financial market issues, macroprudential policy, and statistics. She's also responsible for the risk control of investment activities and monetary policy, as well as the financial stability process and the activities of the management group of the Bank of Finland's pension fund. Finally, Marja is the chairman of the board of the Financial Supervisory Authority. So we couldn't have a better moderator for this webinar today. Without further ado, over to you, Martin.
Thank you, Ernest, and good afternoon also from my side. The purpose of my short presentation is a little bit to set the scene and provide a little bit of background, and also to try to develop some of the themes which then our panelists will discuss. So here is a simple attempt at describing the main building blocks of the modern banking system. There are essentially four different components. So we have on the asset side, we have the loans, we have trading assets from the fixed income market, in particular bonds. And on the liability side, we have the deposits. We have repos, in particular, also from the fixed income trading, and hopefully a lot of equity. A key ingredient to, as already described in the 19th century, banks are special is the public safety net, in particular deposit insurance, and the central bank as a lender of last resort. All these features together allow banks to act as to provide transformation of maturity and liquidity, and thereby engage in a broad set of client business. On the next slide, I start with the major changes for the loans. So loans are really a key element of the banking franchise since the start of modern banking in around the Industrial Revolution in the 19th century. Here, the main change really is the lending to the real economy is to a large and growing degree now happening outside the regulated banking sector, in particular by non-bank financial institutions such as recently created funds. So the global size of this sector is now already close to the banking sector, as the FSB showed in a recent analysis. And on the right-hand side, to illustrate this in particular for the US, from a recent paper, we see the sharp decline in the corporate lending conducted by banks. The next component in the banking building blocks is the fixed income market, in particular bond and repo trading. So bonds serve as safe assets. We have seen, and we will discuss this also in our context, the roles and also the sometimes underestimated risks, even from the side of government bonds in the market turmoil last year. And government bonds are also the main collateral for repo funding, which has become steadily more important since the global financial crisis as the unsecured interbank market has declined. So there are three important changes: rising importance of bond intermediation, a changing structure of intermediation also here, non-banks entering the game, and finally a declining robustness of intermediation, which the indicator derived from US Treasury market prices on the right-hand side shows the increasing risk of liquidity spills in the US Treasury market. So we've had loans. We talked about the fixed income side. Now we talk about really the funding side here. Core instrument are the deposits. Here, the change again is growing competition from the non-bank sector, in particular money market funds. This was, as the chart on the right-hand side again highlights for the US, already a long trend in the US, but we now also see this in the EU to a growing degree. And in the period of monetary tightening, also described as quantitative tightening, here the issues around deposits have come also to the forefront again in the stress which we saw roughly 1.5 years ago with the bank run. So deposits at that time evaporated quite quickly, which in particular Silicon Valley Bank saw as a major problem, so that it had to be bailed out. Another outside the private sector, another potential competitor for bank deposits might soon be, depending on the setup, also Central Bank Digital Currencies. And with this, we come to the next and last important building block, really. So the most important buffer for banks, bank equity. Overall, we see it for EU and also, of course, for the major US banks, a solid position, strong increases in capital and liquidity since the global financial crisis. Just to illustrate this, CET1 ratio, risk-weighted ratio, so not the leverage ratio, is around 16%. And in recent periods, we've also observed record returns on equity. But and one of the issues in particular related to the market valuation of European, EU/Euro area banks is the continuing discount of Euro area banks relative to US banks, where it seems markets, so in particular the equity market, have a more positive view here. In the context of bank equity, one major change which I want to highlight is the use of securitization, not for funding, but really for creating equity. in particular here via the synthetic risk transfer. And on the right-hand side, the chart highlights recent trends. So the loans stay on banks' balance sheet. There's no funding benefit, but then the protection for the losses come from for instance, an asset manager. So this is really a very quick walk through the major changes. And with this, I already come to my last slide, which describes some of the key themes. So really the role of the banking sector in the real economy, and furthermore also the role of the banking sector to fund innovation, and something which is increasingly important in the current environment, also of course the climate transition. Another theme is the banking stress in March 23 and how this has affected the situation of banks. Here also, as I highlighted, with the differences in market valuation, significant differences between US and European banks. Finally, the role of regulation and the implementation of Basel III in the EU and what people call the endgame, Basel endgame in the US. And as a last point, really, more from a political perspective, the development of the banking union and the interlinkages between the banking union and another major economic policy project by the EU Commission, and this is the Capital Markets Union. And with this, I would hand over to Marja to start our panel.
Thank you, Martin. Good afternoon. I would like to welcome you to the webinar also from my side. It is a great pleasure to have these four highly distinguished colleagues here today, and it is an honor to moderate this panel, so thanks to SUERF for this opportunity. But let me now introduce the four panelists here with us this afternoon. I will start with Matt. He is a financial research advisor at the Federal Reserve Bank of New York. His research interests include banking, corporate finance, private equity, and entrepreneurial activity. He received his PhD from the University of Chicago. And the next panelist, Clara. She is vice governor since December 22. She is also full professor of finance at Lisbon School of Economics and Management. She formerly held positions at University Institute of Lisbon between the years 2000 and 2010 and University of Oxford. She holds a PhD in finance from London Business School. And our third panelist, Stefan, has directly been involved in the firefighting of most major financial crises in the last 25 years. Stefan has retired from the Swedish Central Bank, where he had been serving as governor between years 2006 and 2022. He has previously been director of the Monetary and Financial Systems Department at the IMF, general director of the Swedish Bank Support Authority, and undersecretary in the Swedish Ministry of Finance. He also chaired the BCSB, and currently he is chairman of the Toronto Centre for Leadership Training of Supervisors. Stefan holds a PhD in economics. And last, our member in the panel, Thorsten, is director of the Florence School of Banking and Finance and professor of financial stability at the European University Institute. He is a research fellow of the Centre for Economic Policy Research, Sept, and the CES-IFO, and chair of the ESRB's Advisory Scientific Committee. He was professor of banking and finance at Bayes Business School in London between 2013 and 21, and also the founding chair of the European Banking Centre at Tilburg University. He holds a PhD from the University of Virginia. So very skilled and experienced people in this panel today. And now I would like to start the panel and ask the panelists to share their views and insights of this interesting topic. And in order to stay within the given time plan, I'd ask everyone to keep the representations concise. I know they will be, just a reminder here, and approximately 10 minutes per person. And I will start with Mats. We are continuing to face significant risks in the banking system. We are very interested to hear your views about the banking stress of 2023. What really happened? How do you see the implications of monitoring bank solvency? And what is the role of financial innovation in this episode? So Matt, the floor is yours. Thank you.
Thank you. I really appreciate the opportunity to share this US perspective on what is a fairly European specific conference, but I'm hoping I can give some insights on how some of the lessons from 2023 can translate across the pond. Just as an overview, I'm going to discuss a bit of what happened in the US in 2023, some implications for thinking about how to monitor bank fragility and how that relates to our current regulatory frameworks, and then discuss a bit how innovation and competition may or may not have contributed to the bank distress we saw last year. So just to revisit March 2023, we have a basic trade-off between asset illiquidity and funding instability. And this is fundamental to banks since Diamond and Dybvig 1983. The notion that assets sold prior to maturity suffer a low return if liquidated early. And in this case, we had higher interest rates, and that was depressing book values of assets. And so this is just an estimate of the present value of assets or market value of assets on banks' balance sheets relative to the book value. And we can see in the decade leading up to March 2023, these values were very similar. There wasn't a lot of deviation between book values and market values, but as interest rates rose, the market value of banks' assets fell. And in particular, I've highlighted here the red dots are the banks that actually failed in following March 2023. And we can see here that both the red dots and the blue dots are fairly similar. The banking industry as a whole was exposed to interest rate risk. And so you saw a value decline that was very similar across these two banks. The key difference here is not that banks lost asset value, it's that the banks that failed actually had funding fragility. So while asset values declined fairly universally across banks, we see that funding fragility was actually quite different for these banks during this episode. So here I'm presenting the present value of liabilities relative to assets, where we've taken long-term debt as a lower value because we're discounting long-term debt at longer horizons, but runnable debt is valued at par. And so here, when we plot, the industry's distribution of present value of liabilities relative to assets, we can see that the average present value of a liability was somewhere around 80 or just below 80 during this period. But for these banks that failed, they had particularly high present value of their liabilities. And this really reflects the reliance on uninsured large depositors who relative to their peers. So they had a lot of runnable debt relative to their peers. This debt wasn't insured. And when we present value that debt, it's much higher in value and therefore reduces the equity value of these institutions. And the mix of this debt was particularly high going into 2023, in part because of evidence that suggests that the policies during COVID contributed to a deposit boom in the US. And so this led to fertile ground for essential fragility in the banking sector, particularly for these banks. And so when we think about these two trade-offs, the present value of the assets and the present value of the liabilities, they're not particularly well captured by any single regulatory metric that we tend to rely on. And so book capital generally does not account for time differences between assets and liabilities. It treats capital as sort of ongoing concern capital, and it doesn't do a great job of predicting whether or not you're going to be insolvent if your liabilities come due before your assets. So really, it's not reflecting the market valuations in real time. Liquidity metrics really think about your access to liquidity and the liquidity of the assets, but they're not as quick to recognize market conditions, so a rapid change in interest rates, and they don't rely on measures of bank solvency per se. They're more focused on, can I meet the commitments that could come due? In addition, this heterogeneity in types of deposits was really something that was stark during this episode in the US, and it's something that has not been well captured in current liquidity metrics. Lastly, interest rate risk. We have specific models that deal with interest rate risk, but these models don't relate to the other two measures very well. So they don't capture solvency very well, they capture sensitivity, and they're not particularly focused on what your liquidity position is vis-a-vis the illiquidity of the particular assets relative to their current market valuations. And so each of these approaches identifies a different risk, but it's the confluence of these risks that really generated a problem in the US. And so this really suggests that a more integrated approach or a novel approach of thinking about how to jointly quantify the risks that banks face could be to simply net the market value of these assets and liabilities to identify which banks look insolvent in the case that their liabilities come due. And so failed banks on this net metric really look like outliers years in advance of the stress events. And so a metric like this can highlight who's low on this measure of sort of economic capital rather than book capital, and jointly consider the quantitative impact of something like interest rates, along with changes in liability values and other market conditions that can impact the valuation of the bank. Stepping back from this idea of thinking about how to identify these banks, or how do these problems actually inform, how would we try to tease out which banks are fragile? I also took a minute to think about, how did innovation play a role in this event? And that's fitting in with the theme of the panel. In this case, technology certainly increased the speed of runs, and that was evident by how quickly SVB saw outflows. But these failing banks really looked insolvent or relatively insolvent, despite the speed of the outflow. And so the fundamental problem here, while the speed of the outflow made it challenging to resolve the banks or potentially come up with interventions, they didn't necessarily change the fundamental problem of the bank, which is that they had low asset values and high liability values. And so in this particular episode, I'm not particularly focused on innovation as like a source of the distress, although it did play a complementary role. With respect to competition, as was laid out in the beginning, the U.S. has had a long history of a robust non-bank sector, both on the funding side and on the lending side. Money market mutual funds have been operating in the U.S. for something like 50 years. But if we look at deposit betas over that time period, accounting for cyclicality, deposit betas look similarly behaved now as they did 50 years ago. So it doesn't look like there's a particular sensitivity to prices now that wasn't evident in earlier episodes. And transaction accounts still require really unique competencies on the part of banks in order to be executed and provide the services that most depositors expect. And so non-bank competition on this front, while it can present a risk of quantity flows, has not particularly led to bank distress, either in the 2023 episode or in earlier periods. Non-bank lenders have continued to grow, but again, they don't seem particularly relevant to this episode. In this interface between non-banks and banks in the US has evolved quite a bit over time and over cycles. And so despite the fact that there's increased competition, deposits as a fraction of GDP continue to go up. It still seems like there's a lot of demand for banking services. And so the notion that competition presents the death knell of the bank, or even suggests that banks are no longer in demand, it really looks like competition has been able to live with the banking sector in a relatively healthy way. Of course, something like a CDBC represents a really distinct challenge here, because this goes directly to something that depositors have clearly wanted, which is transaction accounts and payment services. And so that really stands outside of what I would think of as established competition in the US at this time. So just to sum up, the 2023 episode, it's a stark reminder that these core business of banking, financing illiquid assets with runnable debt, it's always a present and salient concern. I think both in the global financial crisis and then in this recent episode, but in this most recent episode, most banks were positioned for this challenge. It was really the outliers, the ones who had exposed themselves to highly runnable deposits that looked most fragile. It highlights how the complexity of our regulatory framework still doesn't do a great job of identifying the particular banks early that represent solvency threats. And so there's a notion here where we could still continue to refine or develop a better measure of what banks are fragile, and so that we can better be prepared to either intervene or modify our regulations to reduce the risk of these banks. And lastly, despite competition, the provision of liquidity services, both on credit line side, but also in particular from deposits, remains very much a unique service of banks. And so this really suggests that we do still need banks, just as long as they're properly managed. Thank you.
Thank you, Matt. Very interesting. And thanks for sharing your views on this quite recent episode. Now we will move to Clara. You have a background in academic research, and now you are a senior policymaker in Banco de Portugal. What are your views on the impact of current regulation, and how do you see the progress of NBFIs in the EU, and more generally, the role of banks and the real economy? So Clara, please.
So first of all, well, thank you for inviting me to join this very interesting event. I mean, at least the title is quite provocative. And the previous speakers, and in particular Matt, have already added some thought-provoking remarks. And I'm sure, given my current job, I'll try to refrain myself from getting into too much trouble with my opinions, because as a central bank vice governor, I guess no one expects me to conclude that we no longer need banks. Indeed, I will not. So I also don't believe that anyone would actually dismissively agree that we no longer need banks. But the issue is then, I mean, why do we need banks? What are they here for? And where are banks currently not fully delivering on their role? So, and to address the vernacular question we were given to start with, perhaps we need to go back to basics a little bit. So what is a bank? How does it work? What do banks deliver? Is that still necessary? And what can we do to improve it? So I'll try to address a little bit these different topics. Of course, whenever we think about a bank, we immediately consider a wide array of products and services that are being offered. And at their core, the role of banks is to operate as financial intermediaries, channeling funds from savers to borrowers. So firms and households can safely deposit their savings in banks, who will then lend them to those who need to borrow in order to consume and invest. I emphasize the safely because this requires, like Matt also mentioned before, a stable banking system, which is also protected with backstops and notably deposit insurance. Now, through the core financial intermediate role, banks also play a key role in maturity transformation. So depositors often prefer liquidity and short-term maturities, whereas borrowers need longer horizons to make investments. So banks create liquidity with this maturity transformation, and that should generate growth in the economy. Now, regulation puts a brake in this maturity transformation. So both the liquidity ratios that Matt mentioned that aren't able to cover all sorts of risks, but at least are an improvement, and were introduced in Basel III as a response to the shocks we faced during the global financial crisis, like the liquidity coverage ratio and the net stable funding ratio. Those do impose some limits on banks' liquidity to borrow short term from depositors and from the market, and to lend long term. So, and after the 2023 US banking turmoil that we just heard Matt explaining to us, no one actually disputes, I guess, that having these breaks is helpful to preserve financial stability to some extent. But of course, by limiting one of banks' core functions, regulation is also limiting their profitability. So actually, one of the often alleged reasons for the weakest performance of European banks when compared to their US peers that we already heard about today is that tighter regulation may actually be hindering bank profitability. So of course, we could have a long discussion on this, and perhaps we need more research. But the truth is that we might be missing the crux of the problem. It might just be a lot simpler than sometimes we think about. So if we go back to simple things in our basic training in finance, there is a trade-off between risk and return. So if it's true that regulation decreases the level of risk, then we cannot expect returns to remain the same. And setting up ROE targets based on the levels we had like 15 years ago, perhaps before the global financial crisis, perhaps we would then be in an absurd demand. So as the banking system supposedly has profoundly changed, both due to regulation and also to a change in risk management culture. So what's The upside of this change? Well, a stronger, more resilient banking system, which is better able to withstand shocks and to finance the economy. And again, by doing that, fostering growth, we hope. That said, and coming back to banks' core functions, taking risk is certainly one of them. So banks make decisions about who to lend to. And to maximize profits, they are expected to grant loans to the borrowers that have positive net present value projects. But this profit maximization objective is, of course, not an unconstrained problem. So banks need to strike a balance between the need to take risks to maximize profits and contribute to economic growth, and also the need to protect the funds that are lent to them by trustful depositors. So regulation and supervision are there to push for this balance and to limit risks. Of course, we can ask if we have gone too far. And so, is banking still an interesting investment? Well, I guess it is. I'm sure it is a certainly different investment from what we saw 15 years ago. And perhaps it's an investment that should appeal to a different investor base when we are looking for with a different profile than what we had before. Now, consequences of this change. So by putting a tight leash on banks, the ones that are operating within the regulatory perimeter, we are also perhaps giving incentives for competitor non-banks to grab low-hanging fruits and offer competitive financial products and services with a simpler setting. So the importance of non-banks, like we just heard, has increased significantly, well, both in the US and in Europe. This should boost competition. This has boosted competition, which increases efficiency and also consumer welfare to an extent. But there are, of course, risks. So deposits and other investments in non-banks are not protected by deposit insurance, which makes them more vulnerable to panic runs as well. So the fragility of their funding actually creates uncertainty on their ability to lend, which possibly can amplify market distress. And perhaps more worryingly, there is a lot of evidence that non-banks are deeply connected to banks. So a shock in the non-regulated part of the financial system may pose destructive risks on the regulated part as well. Of course, an obvious solution would be to regulate and supervise financial institutions based on their activities rather than by name or by their legal form. But it's easier to say than to do. Otherwise, we wouldn't even be discussing that here today. Let me also bring to discussion something which is related to what I was just saying, but we don't discuss as often, which is proportionality. So banks undoubtedly face a heavier burden than non-banks in exchange for also an increased charter value. How's that? By offering a more diverse and complete set of products and services than what we expect and than what non-banks are allowed to do, and also by benefiting from deposit insurance and access to the lender of last resort, like was initially said. So these benefits accrue to all banks, but again, perhaps more so to the larger ones that can exert market power over their charter value and that are often too big to fail despite all the regulatory efforts that have been put to put an end to this market failure. But the regulatory and supervisory costs are proportionately much stronger for smaller and medium-sized banks. And so when we add to this the management of cyber risks and the need to invest extensively in technology and in human capital that's able to deal with that to keep up with competition, then the overburden for smaller institutions is clear. So SMBs are then forced to dedicate a disproportionate volume of their resources to these requirements, and challenges being left with little room for strategic thinking, etc., and investment in a solid growth strategy. Should we worry about this? Well, again, there are trade-offs. So on the one hand, we hope that larger banks are more diversified, more efficient, better able to take and manage risks. On the other hand, perhaps smaller banks should be more willing to finance also smaller businesses that are uninteresting to larger banks because of their smaller scale. But then these smaller, perhaps often innovative businesses, if successful, might have also a stronger growth potential and larger spillover effects in the economy. And furthermore, less competition would actually hurt consumer welfare and even financial stability. I'm leaving capital markets for later. So next slide, fine. Coming back to the list of critical roles played by banks, and Matt actually mentioned this a little bit. So we also cannot forget their role in payment. So this is perhaps one of the areas where banks' market power, like I wrote, has become more eroded. Both traditional players like Visa, MasterCard, and the newer ones, say such as PayPal or Revolut, they have taken away a lot of the role that was played by banks in facilitating payments. And even central banks actively offer innovative payment solutions. So Banco de Portugal very recently launched a secure and innovative instant direct transfer system called SPIN. So in any case, banks are not out of this game. So they continue to play a key role in the payment system, sometimes partnering up with technological disruptors, other times preserving unique roles like we see in cross-border payments, for example. And payments are also often the entrance door to financial inclusion, and traditional banks may be more willing to offer these services, or at least they can be more easily subject to regulation that requires them to do so, as is the case in my country, where we have basic deposit accounts that are designed to offer low-cost payment and deposit services to individuals who would otherwise be excluded from the system. Also related with this role, banks also play another important role in helping to fight financial crime and money laundering. So that's also something that we should keep in mind. So now, last but not least, I also would like to highlight another critical reason for the existence of banks, which is their role as well in the transmission of monetary policy. So for central banks to be able to deliver on one of our crucial missions, which is price stability, a stable and functioning banking system is also critical. So this was actually very recently actively discussed a few weeks ago at Jackson Hole. Non-banks also play a role in the transmission of monetary policy, but it seems to be a much weaker one. So if banks are not operating as expected, central banks will have more difficulty in achieving price stability, which would inevitably lead to less investment and then lower growth in the economy. So I already mentioned the challenges to bank profitability that come from regulation, but monetary policy also affects banks' profitability, itself a transmission mechanism in a way. So, and during the previous easing cycle of monetary policy, unconventional policy tools would actually boosted banks' profits, but the low interest rate environment also created pressures on low profitability. So we see the relation here. And in contrast, during the recent cycle, quantitative tightening measures actually created pressure on the profitability of banks that have sizable maturity mismatches, but we also saw the boost in the profits of banks with traditional intermediation profiles, well, at least in the short run, or for as long as liquidity is abundant. So that's also another one to keep in mind. So let me conclude by coming back to the question we are addressing in this panel. Do we still need banks? Well, I would say we definitely do. We need banks to intermediate funds in the economy to make the financial system work, to help us achieve price stability, to allow us to make payments and many other functions. We need banks to make choices about efficient allocation of funds in the economy, transforming informed risks that will allow the economy to grow. Should the financial system be entirely bank-based? Well, absolutely not. So non-banks offer innovative and competitive solutions. And perhaps more importantly, even though in Europe we now have a working, although incomplete banking union, there is still a lot to be done in terms of achieving a similar level of development and integration in capital markets. So banks have the skill to monitor and screen viable projects, but they should not carry on their shoulders the entire responsibility of financing the economy. So a more diverse financial system with different levels of risk preferences should allow for a more diversified set of investment opportunities necessary to foster growth. In particular, if you are worried about growth that comes from riskier, more innovative projects and industries, then you probably want that to be funded outside the banking system, and equity should also play a huge role in this. So that would mean higher risk taking outside the banking industry and an overall general equilibrium solution to finance different risk classes in and out of banks for different levels of stages of development of the companies that are being funded. But that is also the beauty of it, that at some point we reach a level of financial literacy and maturity that sustains a new responsible risk culture that caters for this diversity in allocation of people's resources and investors' resources. So I'm finishing. So do we still banks? Well, if anyone is still skeptical, even all the arguments I'm trying to go through, I would ask just, imagine not having them, and imagine all intermediation being non-bank financial intermediation as we know it. Guess what? I mean, after my cooling period, when I finished my job as serving at a central bank, I guess I would try to innovate, create a bank myself, and imagine no banks existing and suddenly creating something that has deposits, that takes deposits, has deposit insurance, can take the lender of last resort, etc., properly regulated and supervised. I'm sure I would get customers for that business. Thank you.
Thank you, Clara. A lot of food for thought for us to continue this panel. But let's move now to Stefan. As a very experienced policymaker with a long and distinguished career in dealing with financial stability problems, I could say that you are the grand old man of financial stability problems. What are your views on the present state of the European banking sector? What are the competitive threats for banks, and how do you see the links, and if there are any links between the banking union and capital markets union, the issue that Clara already touched upon a little. So please, Stefan.
Thank you, and thank you for giving me the opportunity to speak on this panel. So, do we still need banks? I think that the short answer is actually the same as Clara's that we just saw on the screen, and the answer is yes. Based on my by now quite old IMF experience, and I've seen this in many countries, I would say that also under the worst circumstances, banking systems always recreate themselves in one form or the other. And that's because banks basically produce services that people want and that people need. Some of these institutions in countries I'm not going to mention are probably not called banks, but they are de facto banks. And in a European context, and that's very much what we're talking about here today, this usually bothers old bankers, and it also bothers old supervisors. But I'm not going to talk about the disasters today. Today's topic is more about taking stock. Where are we, and where should we be heading? And I'm doing this with very much with the European evolution in the banking sector in mind. So let me give a very quick recollection of various where we are and various problems stemming from earlier episodes. We had the global financial crisis, we had the euro crisis, we had the pandemic. We've heard a few words about the SVB, we had Credit Suisse, and so on. And essentially, when all of this started, and by now actually almost 20 years ago, there was a lack of capital, high non-performing loans, a problem with the bank sovereign nexus, as it is called in Europe, because when governments run into trouble, banks tend to run into trouble as well, and a lack of liquidity. And we have struggled through this for the past about 15 years, trying to correct these things. And now we are on our way coming out, so to speak, at the other end. And the conversation today is really much about where are we heading, and where are we heading next. I ended up also being chairman of the Basel Committee for almost 8 years, and that means that I did the final negotiation of Basel III. And as one would expect when it comes to bank regulation, half of it is politics and half of it is supervision. And we can argue if those proportions are the correct ones, but anyway, that's the way things are. And as part of that process, I went through and watched many attempts to dilute the whole thing. But eventually, the whole system actually has stayed fairly stable. Except that there wasn't really much focus, for reasons I couldn't fully understand, on interest rate risk, and Matthew has commented on that already. It sort of fell by the wayside, and by the help of the FSB, we had this long conversation about globally systemically important banks and TLAC and all the rest of it, and whether you actually ever use TLAC to bail in bondholders. All of this has happened, and that is important. So then, where do we go from here? That's really the issue. And in European context, the political issue is really how to set the stage for what we want to do going forward. The good news, as we already heard from Ernest and Martin, is that the LCR is fine, return on equity is up, NPLs are down. The cost-to-income ratio, which no one else has mentioned, not too bad, but in some cases in Europe, pretty bad, if you actually look at the numbers. So it's not over yet when it comes to restructuring. So we're still not done. we will probably never get done. A perennial headache in the case of Europe is price to book, because for a very, very long time, market participants have priced banks in such a way that the price is lower than the book value. And bankers and politicians always tend to say that the market participants have misunderstood everything because the banks are actually beautiful. But these people actually invest real money, and they don't think so. So something remains to be done when it comes to that part of it. Of course, if you have a price to book value which for a long time is below 1, that makes structural change difficult. And the issue is, of course, when that happens, you're going to have to dilute the old shareholders, and they try to make that not happen for as long as possible. But in a market economy, either you do the right thing so that the price to book goes up, or you're going to get diluted sooner or later. It's just a matter of time when that happens. Now, I do think in a European context, you need to add that at the national level, you have in many instances quite oligopolistic banking sectors. And that means that the incentive to change is really on the slow side. But then in that environment, what should we look for? What is next? I'm repeating here a little bit what Clara also touched on. At one end of the spectrum, we have payments, because banks have always for a long time been tied to payments in one way or the other. Today we have Apple Pay, we have Alipay, we have PayPal. If you are interested, you can Google Transfer Galaxy, a tiny company that you can use, where you can use your cell phone to send money from Stockholm to Kabul. If that's a good thing or a bad thing, we can argue about that. But technically, it's possible when the old banks don't want to do it. Let me also mention the TIP system, the ECB system for 24/7 real-time gross settlement across Europe. It is remarkable that many major banks don't want to use the system. That is a failure. And either they start using the system or somebody else is going to start using the system. And that's what you need to do in order to stay in the payments business, because today people actually expect instant payments in one form or the other. Or maybe the evolution of this whole thing is such that banks actually over time move out of payments entirely. But that means that you have to have new players that are tied to the banks, to the central bank's payment systems in one way or the other. At the other end, and we've already heard about this, non-bank financial institutions, shadow banks, money market funds, stable coins. I actually call stable coins unstable coins, because if you scratch on the surface today, you just cannot understand what on earth it actually is. But people sort of like these things and look into it. And many of these services of course don't have a banking license, despite the fact that they're very, very close to being actually banks. And then we have this fantastic new term that I came over the other day, neobanks, banks without brick and mortar, banks without offices at all. Revolut has already been mentioned in Sweden. We have Clara. Clara is doing fairly soon an IPO, and they're sort of, you can use Klarna services in many parts of the world today. And then, since Matthew is also on the screen here, we have Kraken Financial in Wyoming. If you want to deposit Bitcoin, Kraken is actually a Norwegian word for a sea monster. So why one would ever use that name for a bank, I don't know. And I'm certainly not a customer of the Kraken Bank. And I know that some supervisors and some banks in the US actually do not transact with Kraken Bank at all. But it's just one example. And what this actually means today, setting all regulatory frameworks aside, is that brick and mortar banks actually need to position themselves in this new world. They need to figure out what to do next. And that's not a regulatory issue. That's an issue where they would like to be competitive, what kind of services they would like to sell in the future. And that will, of course, determine in the end whether they will stay or not. At the same time, there are, of course, transition costs when you do these things. And what is very dangerous if you're an old brick and mortar bank is that with a fairly high likelihood you're sitting on 30-year legacy systems and the IT systems, and that's not the case for the new neobanks. So already there it's hard to compete. And also you have to watch out so that if you don't close branch offices and add an IT-based bank, then you basically have created two banks. And then your cost-to-income ratio is going to go up instead of going down. And that will actually be quite dangerous in the long run. So you also have to accept cross-border mergers. I actually do think that in the European concept, we need more cross-border banking. And then that, of course, brings us to Europe and a European perspective. And to oversimplify, you can use two perspectives here. One perspective is to think about national banks in Europe. But I actually think that in the long run, that's the wrong perspective. A much better perspective is to think about European banks in the world. And if you don't do that, I'm afraid that the European banking sector will lose out to other banks in the world sooner or later. And this is really my latter view, despite Sweden being only kind of half a member of the EU. So my views are different maybe from what some Swedish politicians think about this. So based on that, I think it is important to try to complete the banking union. And new initiatives are really, really welcome after 10 years of SSM. And in other fora and in other conferences, we have discussed 10 years of SSM and actually concluded that it's a success. But there are more things to be done. And we do need a European deposit insurance system as a minimum for large SSM banks. We need to think about the rights of the SRB. We need to think about sovereign risk weights or other limits when it comes to holding government debt. And that means that we actually need to produce a list of what I would call harmonization projects. And these next steps on that kind of a harmonization project should, in my view, be very, very high on the agenda of the next commission, because these things haven't really moved for quite some time. The other part is the capital markets union. And let me put it in the following way. I think that it's the wrong way of thinking to say that Europe is bank-centric and Europe should remain bank-centric. Because then you basically have put all your eggs in one basket, and that's not a good place. That's not a good place to be, because we also know from experience that when things go wrong, market functions the worst when you need them the most. And then if you have many markets, maybe at least a few of them will work, compared to just having one market that collapses almost immediately. I have participated, and Marja has probably also participated in a number of informal ECOFIN meetings over the years, when at the political level, the capital markets union has surfaced. And what happens when you get to that agenda item is that people's eyes glaze over, or they leave the room and go and have a cup of coffee. And that's because this is about the plumbing. And at the political level, plumbing is difficult. And you have never been confronted with arguments about the plumbing. So at the political level, most politicians sort of tend to think plumbing is for plumbers. Why should I have to deal with this at all? And by the way, to fix the plumbing takes decades. And with a 4-year electoral cycle, why would I bother? So then you leave the room and nothing much happened. Having said this, my view is that the capital market union is a complement. It's not a substitute for a banking union. And that means that we need to harmonize many things, legal frameworks, technical transaction systems. What the ECB has done is very, very promising, taking target 2 securities, target tips, and all those things. Because somebody has to provide a pan-European infrastructure, because otherwise it's meaningless to talk about a capital markets union. Also note that if you read the Letta report, it also talks about the banking union, and there's a whole bunch of other reports that are sort of in favor of banking union. But when you get to the appendices and ask yourself, okay, everybody's in favor, what is it that we're supposed to do? Then the to-do list is very short and rather non-technical. So it seems to be very, very difficult to get sort of over that and actually start to do some real work in this field, because the to-do list basically is not precise enough. Because there hasn't been enough political support. But I do think here the Commission also has a serious role to play when it comes to producing that to-do list. Also, what makes it difficult is that the capital markets union in many, the capital markets union at the political level is kind of supposed to solve all sorts of problems, and that means that it's difficult at the political level to actually talk about one and the same thing, because some people are talking about green bonds, others are talking about more equity to SMEs, and again others, and I'm certainly myself is supporting that, are talking about the need for a pan-European risk-free bond. And that means that this kind of project is very, very hard to run, because you need to decide on what to do and how to order these things. And it's probably physically impossible to do all these wonderful things at the same time. And it will take, let's say, 5 to 10 years to put these things in place. But get these things done. And once they are done, you just have to accept structural change. And if you try to hinder structural change, then the European banking sector probably, or some national banking sectors probably, will have problems for years to come. I do think that European banks also can thrive in the future and in a global context. What regulators and politicians can do is to set the preconditions right. And this is what the infrastructure and rulemaking is supposed to do. But the rest is actually up to the banks to handle themselves. And those who refuse to do that then probably will lose the business to others. Thank you.
Thank you, Stefan. As a moderator of this panel, I refuse to comment on your thoughts, but very I share the views. It's really the devil is in details. It's on a high level. It's easy to say that we need capital markets union or we need something else, but then when you go to details, then it gets difficult. So fully understand and fully share your views. But let's move on. And finally, we have Thorsten, and you have been actively leading cutting-edge research on banking. So what are your observations on the topics raised, for example, by Martin in his presentation at the beginning of this panel? What does research have to say on banking system? So please, the floor is yours.
Well, yes, thank you very much. And first of all, apologies for being late. It's the first, I'm in the airport, and it's the first trip of the academic year, and already 3 hours delay, so I think it's starting very well. Anyway, I have a couple of slides. Now, the good thing of coming late is that I will not feel embarrassed by repeating what others have said, because I haven't heard it, except, of course, for Stefan's, and I disagree with very little what he has said. So there's nothing major in these slides. It's more like a talking notes for me. The question being, do we still need banks? And of course, the answer will be yes, but I think if I come back from the research side, I mean, there is a long established literature on the relationship between financial development and economic growth. Now, this literature, interestingly, kind of came from the developing emerging market perspectives. So it was never kind of focused on high income countries per se. And I think from the very beginning, when we ran these regressions, we always looked at nonlinearities. And not surprisingly, also follow-up research has shown that if you go to higher income countries, to the Denmark, Sweden, Germany, Netherlands of the world, then there's limited, if any, or even negative gain from further financial deepening, typically measures as additional lending to the private sector. One of many reasons being that it's typically an additional lending doesn't go to productive enterprise anyway, it goes to households for mortgages, which might be, it's a good thing too, but it might not be necessarily growth enhancing. Now, I would also say, and here it's, I don't disagree with Stefan, but I have a little bit of a different focus, is that we need a diversified financial system, primarily also because the challenges that we're facing might not be best addressed by the banking sector, because the bank debt as such, typically with collateral, is most appropriate for existing technologies, for tangible capital, not necessarily for intangible capital. We also know that uncertain technologies, new technologies with uncertain outcomes are better financed by equity, hybrid contracts, and non-bank financial intermediaries and markets. I mean, if you can look at the tech companies, there's little, especially the early ones, there's little, if any, bank lending involved in these in the rise of these firms. Also, banks, and that's the last point I want to make, is also banks might not be necessarily interested in funding new innovative firms, because ultimately the success of these firms might undermine the existing asset portfolio if they lend to incumbent firms. So there is also a competition issue in there. So putting all together is that we really need to look beyond banks, and we need more non-bank players, as already also pointed out by Stefan. And again, this is a whole array. This is not just like one segment. It's of course the markets. Can be venture capitalists, equity funds, all kind of funds, private lending, and so on, angel financing. But again, it's a much broader financial system, more diversified financial system, as Stefan said, that we need in Europe, and that we could definitely benefit from, especially if we think about these challenges ahead, like the twin transition, digital, climate change, and also the demographic changes. Now, I think coming back to this issue of capital market union, like Stefan, I don't see this as either or. It's both. And there are things to be done both on the national and in the European level. I think the strongest argument for the European level is the scale economies, the necessary scale. I mean, why is it that firms, young tech firms, when they reach a certain scale, are going to London or the US for financing needs? Because the market in Europe is, or in their respective nation, is just simply too limited. As Stefan pointed out, there's a long policy agenda. There's a lot of plumbing going on. I agree with that. However, I think the biggest barrier, it might not necessarily be that the policymakers are bored, but it's the national resistance. And it's national resistance on all levels. It's resistance on the banking sector level. I mean, I still remember a representative of the Savings Bank Association in Germany once telling me, why do we need capital markets in Germany? All existing firms in Germany have funding from savings banks. Well, yes, the existing ones, exactly. So national banks, national banking associations, national regulators, national clearing systems. So there's a lot of resistance on the national level. And fortunately, I have to say, we don't have a crisis that can kind of trigger these reforms, as in the case of the banking union. So the question is really, how do we get there? How do we overcome these national resistance? One thing is, I think we need a champion, as we've had it also for the banking union in the form of the ECB. And we might need a big political bargain, as we again had it also in the banking union. I think what has to be made clear is that we can only overcome, and I mean, Mr. Draghi, Mr. Letta, I think are making this point, or Mr. Letta has made this point, Mr. Draghi will make this point, that if you don't want to fall behind then we really have to do something big. And I think linking the capital market union reforms to such a political bargain and to make it clear the growth benefit we would get from it is an important issue. Just one quick remark on what Stefan pointed out on the banking union. I also think that the banking union is not complete. I think the same problems that hinder the completion of the banking union also make the banking union only a necessary but not sufficient condition for a truly European banking market, and that's the politics. That's the national politics behind it. I mean, national governments still think too much in terms of national champions rather than European champions. Actually, interesting enough, Scandinavia seems to be a little bit more ahead with this in the case of Nordea, for example. Although I don't want to, let's not go into this area. Okay, a second kind of topic that I was given to talk about, and I can talk very briefly about this, is this whole issue of capital versus lending. If you, it reminds me of a conference a couple of years ago at the Bank of England, actually, where there was this question in the room: who thinks that we need more capital, or that we have sufficient capital buffers? All academics raised their hands, saying we need more capital. None of the officials made a statement, and I think that reflects it a little bit. So, put it differently, there is not really a trade-off in the long run, at least, between having higher capital versus lending. Now, of course, it's not a linear relationship either. I mean, you can take it to the extreme, right? I mean, going to 100% capital to narrow banking would not work either. So I think that you have to, it applies to within a certain range. And there is also evidence that the Basel III reforms, for example, have not resulted in lower lending. Obviously, there's this adjustment process. Obviously, some firms might be hit, and that brings me to the broader point of that. Also, if you look not in the long term but over the cycle, then yes, there is, of course, when you tighten capital buffers, for example, to the countercyclical capital buffer. Yes, there will be losers. The riskier firms will lose out. That we have shown this in empirical work, and that, of course, then you face a typical trade-off that policymakers often face, which is the short-term gains, which might result in medium-term pain versus long-term stability. I want to very briefly talk about the 2023 banking turmoil. I don't think that's what I'm having here on my slide is anything new for anybody, or I hope nobody disagrees with it. The most interesting thing is that the euro area was not affected. A little scare there in the CDS market. The question is, what can we learn from it? And actually, that refers to a ASC report of the ESRB, which we just published last week, plus some additional remarks from myself. I mean, so one thing is definitely and I'm sure that Stefan can agree with me, given his long global experience. Rapid growth of a financial institution is a very good predictor for subsequent fragility, and I think we've seen this also in the case of the US banks that failed. Also, this idea that there is a natural interest hedge for banks with different sensitivities on the asset and liability side linked to the deposit franchise. Yes, during good times, but it breaks down in the worst times and the worst possible moment, and that's what we saw with the SVB. I think we've talked a lot about concentration on the exposure side. We have to talk more about the exposure, the concentration on the liability, on the funding side, similarly to the business model of banks. Now, one thing, I think this has also been mentioned before, if I remember the presentations correctly, is, of course, the speed of deposit runs have gone up enormously. And we have some nice graphs in our report if you compare the 2008 fragility, for example, with the 2023 fragility. Now, what does it mean for policy design? I think, I mean, again, coming purely from an academic side, how we treat interest rate risk in the banking book should really vary according to the fragility of the funding side. Now, it might not always be possible to do that, and of course, doing so would also invite regulatory arbitrage. But I think also the fact that this is partly taken care of in Pillar 2 right now is probably the most appropriate way to do. Now, we've discussed too big to fail for now a couple of decades. It's still alive and kicking. I don't think we're going to ever get away from it. Actually, even getting just to a resolution per se is difficult, as we also saw in the case of Credit Suisse, and even including in the euro area. I mean, my conjecture is if there were a large bank to get into trouble, I'm not 100% sure that it would be actually resolved according to a resolution plan or strictly according to the rules of the BRRD. Right. Now, maybe one thing to finish up on supervisors, actually come also back to the issue that Stefan briefly raised. I think the fact that the euro area banks have not really been affected by this turmoil, there was no spillover effect, I think is partly really due to the credit to the SSM. For example, their focus on business models, on governance structures, which were two issues that were definitely went wrong in the case of SVB. So I think that speaks to the benefit of the SSM and to the enormous progress they've made over the past 10 years. Yes, there is, and I don't want to go through all of these points. There's an interaction, of course, between capital and liquidity buffers, which we might need more reliance on Pillar 2 requirements. Also, there is this issue of trade-off between the rules and discretions, and of course also Pillar 2 then also linked to the two stress tests that might also have to be expanded to new areas of stress. And of course, beyond what I have already here is, of course, cyber risk. I mean, the SSM has also now done cyber risk tests. And finally, I think we've learned that recovery and resolution options are still not being used properly. I mean, again, we saw it also in the case of Credit Suisse, which means probably they're not being used because they're not easy to use. I think we have too strong a focus on resolution/liquidation in the euro area, and there should be also a stronger focus on recovery, which again would allow the supervisors to intervene earlier. It would also give more time for supervisors to figure out what to do with a failing bank. So, in summary, do we still need banks? Yes, but we also need a more diversified financial system in Europe. I think bank regulation supervision needs a constant adjustment to new developments, new potential sources of fragility. We're now discussing, of course, the whole area of non-banks. Do we need more prudential rules, both micro and macro, for the non-bank area? And I think that's an ongoing race between cat and mouse. As the risk is being shifted, as regulations are being tightened here and there will be new forms of intermediaries markets coming up, which might have to come under supervision, regulation or not. Now, I find it interesting to enter this note. I think yesterday or the day before, there was this first list of potential commissioners and their assignments, their respective assignments coming out. FISMA was not mentioned. The financial services was not mentioned in this list. At least I haven't seen it. Maybe there are people from Brussels no more. And it's a bit frustrating, I have to say, because I still think that the financial sector and the necessary reforms should be top of the agenda. Obviously, if you ask politicians, they're going to say no, that's really on the bottom now. We have so many other problems in the EU that have to be solved. But I think the financial sector can provide a critical solution, a critical contribution to resolving many of these problems. Climate change, digital transformation, including war financing. So I think there is something to be said to really push more for the financial sector agenda not just in national capitals, but also in Brussels. Because again, we need a sound, effective financial system which can support the European economy. Or put differently, without it, we won't get where we want to go. Thank you very much.
Thank you, Thorsten, and thank you all panelists. It seems that this first round already has created a lot of questions and very relevant questions from the audience that we have here today. And looking at the amount of these questions, I think that we could have easily had a 1 day or 2 day conference on this topic. So if it's okay for Ernest, I think that I could take one of these questions. and then you can our distinguished panelists can decide who will take the answer, or we can maybe take a couple of comments on this. This question is from Thomas Meyer, and the question is, or the question is that is not the main reason why we need banks in our present monetary system that banks create money through lending? Isn't the private-public partnership of money creation of banks under the direction of the central bank a key reason for the frequent financial and banking crisis? Could not the creation of CBDCs completely change the money creation process and hence our monetary system? Yeah, big things. Who would like to take this?
Agree. I don't think the digital euro. I don't think the digital euro is a CBDC though. It's a payment system. So I don't think. But I see that there is there is. I mean, again, while being at the ASC, we also wrote a report on the possible impact of CBDCs on bank intermediation and pointed out a potential negative effect. And I think this has to be stay in the mind of policymakers when talking about CBDCs or talking about things like the digital euro. But I agree with this point. Yes, we will always have banks, even if we call them differently, and there will be hopefully new banks and different banks. I think it's important to, if we want to get rid of them, and some people want to get rid of them, then you better think carefully about the implications for the overall monetary system.
If history gives us any guidance, we know from pretty much the 1800s that if you need to look for some kind of a combination of private sector and public sector, because if you have a private sector banking system only, all of them crashed in the past, sooner or later. And that's where most of the central banks came from in one way or the other. Now, where we are struggling with this, and I'm oversimplifying, is that in the old days, and our way of thinking comes from an environment where everything was on paper. Now we have to move into an environment where nothing will be on paper because everything will be digital. And that's where we struggle with these structures and what to do and what not to do. But also let me add that, and this is to echo what Thorsten just said, banks have specialized in trying to understand what companies do. And the public sector is not very good at doing that. And in all those former planned economies where you had what was called the monobank system, you had one government-owned bank. It took decades actually to get out of that corner in order to create something better. And in most cases, old-fashioned monobank systems tend to create huge problems as well. So the underlying issue is really to find a balance when we do these things. The ultimate, of course, is as some people think that you should go to stable coins or you should go to Bitcoin or call it whatever you like. But again, if history gives us any guidance, those systems tend to collapse sooner or later. So the public sector actually needs to, in a legal sense, define what money is. Without that, you would end up in chaos sooner or later. But the hard part is to find the proper balance.
Thank you, Stefan. Thank you, Thorsten. Clara, any views on this?
Well, I mean, I think Thorsten and Stefan, I couldn't agree more. I mean, that's exactly the situation we're facing. I guess for currently this project, the CBDC by the ECB, etc., at European level, well, is important because it will make us be technology wise, and the ability to know how to work with this new technology is something that I think it's important given the stablecoin unfair competition, because with what proper currency is, it's important, I think, that central banks are able to pass the image to society that we are able to use technology in the best possible way and to compete, if had to, with other entities that aren't as sound as central banks or the banking system itself is. The way it's being designed so far, there's still a lot to define. There are many, many details until the final moment to be decided is quite cautious, right? So the plan isn't to eliminate the banking system as it is, as we know it. I mean, the design is really the initial plan is to have something that's reasonably small, to make sure we learn and understand how it works, and the future will tell us how we reach that balance between public and private intervention in payment systems, etc., in money creation. And I think that's as far as we are going right now. I would say that. So agreeing fully with what both Thorsten and Stefan said. Yes.
Thanks, Clara. Mats, any comment on this?
I would just point out, of course, it's really important for this public-private partnership and the creation of money, but banks existed before we had fiat currencies. So they're also serving a purpose in the economy that goes well beyond just the transmission of monetary policy or the management of the money supply.
Okay, thanks. If you allow me, I will take one more question. This is coming from David Elvelun. The question is that a useful way of framing the issue is that we need banking, but we don't necessarily need banks. Three types of disintermediation of banks emerge: first, by borrowers and end lenders dealing directly with each other, for example, crowdfunding; and second, by borrowing and financing through organized markets; and third, through non-bank financial institutions as shadow banks. This raises the central issue of who and what should be regulated and supervised, and what reasons. Who and how they should be regulated and supervised. We have a couple of minutes to go, so who would like to comment on this?
I actually touched on these topics during my initial intervention, right? Imagine not having banks, imagine not having entities that were properly regulated, supervised, etc. How to coordinate all these activities, and where would we have safety for whoever is making deposits or allocating money, etc., etc. So the system would overall be a lot more fragile, and I really don't see us being able to move in that direction. That would be making us a less developed, a less advanced society in many ways. So this is just, a very short, politically correct answer to start the debate on this topic. So it's all very nice that when we discuss crowdfunding and all those activities, but who's mediating these contracts? Who is going to be there when things really go wrong? How are we going to make this a large-scale way of transferring money from lenders to borrowers, from etc., etc.? That's something that only banks really do have the deposit insurance component that we still need to complete for the banking union in full in Europe, the lender of last resort element as well. So those are so specific to the banking system as we know it today that they do make a very strong difference for our societies, for all individuals and for whoever relies at least partly on bank funding. And even for those who don't, the fact that the economy also has that component. Of course, like we discussed before, having a more diverse financial system, and especially in Europe where capital markets aren't as popular as they are in other parts of the world, that's also something that we must invest in. It's not in the shoulders of banks, like I think I mentioned before, that all the financing of the economy should be relying on. So it's making sure that we have a risk culture that's sufficiently developed, that people and firms know how to allocate the different components of their funding to get different components of their funding in different stages of development from different markets and institutions. Right?
Thank you, Clara. I think that we have time for a very short comment or answer, if someone has an answer for this very prominent question, and before I hand over to Ernest. So
no, very quickly. I mean, so I agree completely with Clara. And if you look at the so-called what he calls the direct intermediation crowdfunding, I don't think that's really that much the case anyway. I mean, a lot of these platforms on the funding side have moved to institutional investors, not necessarily to retail anymore. So that's one thing. So I think there is still an important role for banks. And number two, of course, we talked earlier about the money creation function. So the private money creation function. Now, if you want to get rid of this, okay, you want to replace it with something, but you better think very carefully about the implications of that. And I'm not quite sure a different system would be more stable. I somewhat doubt it.
Stefan here, let me add to that over the years, when I listened to many conversations about what the banks should be doing, actually those who make the interventions talk about equity. And banks are not supposed to deal with equity. And that's why you need functioning equity markets. It's sort of nice to talk about banks lending to me if I run a small company, because then I don't get diluted. But actually, you need to understand the risk profile. And that's why in many, many instances, it's not really for the bank to do this, that, and the banks to do this, that, and the other. It's actually more about thinking about a functioning equity market.
Thank you, Stefan. And on my behalf, thanks for all panelists. It has been very inspiring and good discussion. And I noticed that there are a lot of questions, but I will hand over to Ernest to decide how these questions will be answered. But thank you, and over to you, Ernest. Thanks.
Thank you very much. You asked me for the silver bullet. I have no answer either how to cope with all these questions. I think we have really run out of time. And I would like to take the opportunity to thank Martin again for organizing this event, for Maria for moderating this so smoothly and so eloquently. Thanks to Matt, Clara, Stefan, and Thorsten for taking the time for your presentations and for being prepared to answer the questions. And thank you to all of you for your interest, for your participation, and for your many questions and comments. As Maria pointed out, we could have extended this workshop now for probably a whole day, because there are so many interesting questions. But I take along, in any case, I think there was consensus on this, that banks are here to stay. They have important functions to perform also in the future on many levels. But non-bank financial institutions have also an important role to play in order to increase competition, to foster innovation also among banks, and also to improve financial services for their customers in fields that banks might not be optimally placed to perform, for instance. So thanks again to all of you. Bye-bye and take care.
Bye-bye.
Thank you.
Bye now.